My name is Fisogo Fiamboto, and today I'll be taking you through some of the highlights from our Mr. Price report. Just on the summary side of things, we have a buy recommendation maintained with Mr. Price with an intrinsic value of 217 Rand. The current upside is about 20%. It was about 21% when the report came out. The price just moved up a bit since then. In terms of our reasoning and our stance as to why we have maintained our recommendation, we've seen that Mr. Price has a more stable and consistently higher net income margins when you compare it relative to peers. You'll see in the following slides the picture contrast between gross profit margins as well as net income margins. When it comes to gross profit margins, Mr. Price is lagging a little bit behind Truworths and TFG, but when it comes to margins, it's typically more superior and higher and more consistent than its peers, just with the exception of Truworths in the last 2 years. Reason being, Truworths had that tailwind of a growing reliance on credit, so that did give it a little bit bump on the SA business, and then as well as the turnaround and improved performance of its UK leg, in conjunction with the little bit of weakness of the Rand, which saw it trickle down positively into their bottom line. But overall, Mr. Price still looks a little bit more attractive when it comes to a comparison of net income margins. The other part would be a more attractive balance sheet. Mr. Price typically has less long-term debt relative to peers. When it comes to interest coverage for their revolving debt, they're well covered. When it comes to their cash balances, they're typically quite high. The bit of a kicker in the most recent year has only been because of that Studio 88 purchase, but typically they have quite high cash levels relative to their revenue, and then an overall more attractive balance sheet when compared to peers. I think the other important thing to mention would be their load shedding coverage. When we were experiencing the terrible levels of load shedding towards the end of 2022 into 2023, Mr. Price was in the back foot when compared to peers in terms of coverage, which is why they had that bit of a downward kick in performance during that period. But that risk now has been mitigated quite nicely with that 100% coverage. I think it was by the end of June 2023. The other part is we had an issue with inventory levels, which did impact gross profit margin. What we expect now is more of an expansion as the sector moves to more full price sales because of more comfortable levels of inventory. And then just lastly, more of a sector talk than anything else is interest rate cuts should improve affordability across the sector, but because of Mr. Price's low price to value proposition, we anticipated to benefit from that quite well. In terms of things that would change our minds, it's just 3 minor points. The first one being a deteriorating consumer environment that affects affordability. That wouldn't only affect Mr. Price, but the sector as a whole. Second point being port disruptions that impact the availability of stock. We've seen that in their trading updates in December when we had this issue with these port disruptions, that shrinking availability of stock does impact consumers want to buy, as well as the availability of things to buy. And then just on the last point is high levels of discount sales, the contract gross profit margin. So we think that risk is more on the lower end in terms of probability, given that in the trading updates by Mr. Price as well as the peers, they revealed that they are reaching comfortable levels of inventory, which would not require them to start selling a good portion of their goods at discounts.